Let me welcome you all to this first press conference for the Financial Stability Report, published under the auspices of the bank's new Financial Policy Committee. With this press conference and the publication today of both the report and the record of the FPC's meeting, we are making an important step towards improving the openness and transparency of financial stability policy making in this country. The purpose of the FPC is to act as the guardian of the resilience of the UK financial system. Although it is not yet on a statutory footing, the FPC is charged with identifying and monitoring systemic risks and making recommendations to regulators and financial institutions to mitigate those risks. In today's report, the FPC is publishing 6 recommendations. They relate to areas of the financial system in which we are concerned that risk is increasing. The most serious and immediate risk to the UK financial system stems from the worsening sovereign debt crisis in several euro area countries. As the report makes clear, direct UK bank exposures to those economies are limited. But experience has shown that contagion can spread through financial markets, especially when there is uncertainty about the precise location of exposures. A UK bank could have lent to a bank that itself had lent to a bank that in turn was exposed to sovereign risk. The committee therefore judged that greater clarity about the extent of these exposures would help to limit the transmission of problems to UK banks, and that this extra transparency should be a permanent part of major banks' reporting. So in its first recommendation, shown on page 1 of the record of last week's meeting, if you look at the document, which is the record of the meeting, you'll see the recommendations listed there. And the first recommendation is that the committee advises the FSA to ensure that improved disclosure of sovereign and banking sector exposures by major UK banks becomes a permanent part of their reporting framework, and to work with the FPC to consider further extensions of disclosure in the future. There's no evidence that the euro area sovereign and banking sector exposures of smaller UK banks are significant, but to dispel any doubts on this point, in its second recommendation, the committee advises the FSA to compile data on the current sovereign and banking sector exposures of other UK banks not subject to the EBA stress tests. If those exposures were significant, then the FSA should publish an aggregate estimate. Another risk identified in the report concerns the adequacy of provisioning. When lenders choose not to take action against borrowers who are in arrears or in breach of covenants, known as loan forbearance, it's important that adequate provisions are set aside for prospective losses. This isn't to suggest that forbearance is wrong. It may well make sense for both parties to a loan. But if provisioning is inadequate, banks' reported profits and levels of capital may provide a misleading picture of their financial health. The FSA has done some initial work in this area, but without further information, it's difficult for the FPC to be confident in its overall assessment. And so in a third recommendation, the committee advises the FSA to extend its review of forbearance and associated provisioning practices across UK banks' household and corporate sector exposures on a global basis. Since the end of 2007, the major UK banks have reduced leverage and increased their capital by £117 billion. But in the light of the uncertainties in the world economy, there is a strong case for banks to build up their capital levels further when the opportunity arises. For example, when earnings are relatively strong. Such opportunistic capital building is the committee's fourth recommendation. The committee advises UK banks that during the transition to the new Basel III capital requirements, they should take the opportunity of periods of strong earnings to build capital so that credit availability is not constrained in periods of stress. So in good times, the banks should retain more of those earnings rather than distribute them to shareholders or as compensation. The committee is clear that the purpose of building capital in this way is to improve resilience without jeopardizing credit availability. It is not to accelerate the transition to the new Basel III capital requirements. Rather, it is to build up a buffer of capital over and above the minimum required level of capital in good times in order to run down the buffer in less good times. And to make this effective, in its fifth recommendation, the committee advises the FSA, as part of its regular supervisory dialogue with banks, to ensure that the proportion of earnings retained is consistent with the FPC's advice on capital. The committee is also monitoring risks at the level of the financial system as a whole over the longer term. Of particular concern is any increase in financial system interconnectedness and opacity, since the use of complex and opaque funding structures can disguise the build-up of risk. Exchange-traded funds provide one example of a contributory factor to this tangled web. For good and proper reasons, these funds have grown rapidly in recent years, with the size of the European ETF market now estimated to exceed $300 billion. But complexity has begun to creep in, especially through so-called synthetic ETFs. And the assets of ETFs are increasingly being used as a source of funding for some banks through collateral swaps and similar transactions. So in its sixth recommendation, the committee advises the FSA that its bank supervisors should monitor closely the risks associated with opaque funding structures such as collateral swaps or similar transactions employed by exchange-traded funds. Focusing, as the FPC must, on risks to the financial system can leave one feeling rather depressed. We can't hope to prevent financial crises from happening, but we can build institutions that help to ensure that our financial system is more resilient in future. Today marks the start of that process, and I hope that you will watch the evolution of the FPC with interest. Our new committee will have a team of 11 voting members when it's fully up and running. Today you see on the platform the five-a-side version, who now stand ready to answer your questions.